Hi, my name is Maveen. I am from discoveryourlifetoday.com. Thank you for joining me. Just to get this quickly out of the way, if you haven't already done so, please remember to subscribe to the YouTube channel. You can also follow me on Facebook, Instagram, and Twitter. You can either look me up at my name, check out discoveryourlifetoday.com. If you want to find it, I guarantee you'll want to look for it, or you can check the bio. It's also in there. Today, I want to talk about how to avoid and take advantage of 3 money traps. The reason I want to talk to you about this is kind of goes with some of the experience that I have. I've worked in the banking industry for the last 20 years, on and off. I've got probably about 10 years of experience. I just want to go through some of the things that I've learned, that I've seen other people kind of do and fall for in these traps, and help you avoid these traps that I've seen other customers that I've dealt with personally fall into. When you're ready, let's begin and let's go through that. So what if I told you that you've been lied to and sold this big money trap problem? The lie that you've been sold and told is that it started when you were a child. Too many of us continue to believe this lie about money until this day. We were told to go to school, grow up fast, focus on the economy and technology. Get a good job and earn a lot of money. Buy a house, the nicest house in your neighborhood. Get a couple of fancy vehicles. Accumulate a whole bunch of debt to live the lifestyle that you want to live. And don't worry, work 40 to 65 hours a week for the next 40 years. And you'll be really happy. Do you kind of remember that? Well, you were sold that idea, and so was I. And you know what? We didn't know any better, because our education system really didn't teach us. So let me know how things are going for you. If you were told this as I were, do you think you'll be able to retire comfortably in your old age? This means that if you're lucky, by the age of 65, you'll reach your golden years and be very happy to retire. Look around you. Let me know if that is really what is happening based on what you were told. So when did it all start? As we grew up, we were sold the biggest lie by some of the most important people in our lives. Our teachers, our parents, our family members, our financial institutions, they all taught us about this money trap. I believe we were all brainwashed by what we want to be told by the news, the stuff we read in the papers, the stuff we read online, and even stuff that we hear that is advice from our friends. Sometimes we take this advice from well-knowing and meaning people only because they've been sold this money trap as well, and they really don't know what other advice to give because they haven't been taught or learned anything different than what they were told. I do believe for the most part people are good and want to give us great information based on what they know, but they only know what this system has taught them. So what are the money traps? Or where do the money traps occur? This corrupt money system teaches us how to get ahead financially in this world. The truth is, the only people getting ahead financially are the people who operate the system itself. The only way to start it the only way is to stay at the top by luring people to accomplish their dreams and retire rich and be able to live a great life when you are old. Who wants to really live a life that's fantastic when they're old? Don't you want to live a fantastic life when you're young and have all this energy and vibrancy and about yourself? Why not live that amazing life today? Why live that amazing life after working 40 to 65 hours a week for 40 years and then want to live that life? Why not be able to live that amazing life today in no debt and avoiding those 3 money traps that I'm going to go over with you? As hardworking citizens of our communities, we go to school, we pay bills, we go to work, and we try to put some money aside for the future. And I say try, because trust me, I've worked at the bank, like I said, and I've seen people's bank accounts, and people are trying to put money aside, and not everybody is able to. So just, be aware of that. So what's the first lie? I think the first lie is just where we started, is our school system. First, we're told to go to school, get an education. Although there is nothing fundamentally wrong with this advice, it is what is taught in the schools is the actual problem. We are taught by teachers who mean well, but don't understand our biggest challenges as a student or even the human race. They don't understand the challenges we face because they're trying to earn a paycheck themselves and really aren't teaching what they should be teaching us. They're only teaching us what they're being told to teach us. Second, teachers don't really make a lot of money. And you know what? When your average income is somewhere between $30,000 and $60,000, you're really just working for a paycheck, and you're not always considerate of what you need to teach the children or the people who are trying to learn in higher education as well. The system makes sure that the people who teach us also themselves are fundamentally having financial troubles, because teachers don't make a lot of money themselves. They don't really qualify, in my opinion, to teach children about financial literacy. Second, or part of it, I guess, the school systems make sure that the teachers aren't, like I said, financially literate, so they really don't understand how to teach the same thing back to us. If they did, they probably would be in different jobs or different situations. You know, I get it. Some people are going to say, oh, well, teachers are passionate about what they do. Absolutely. And I do believe they should get paid more, but they should also be teaching us things that are going to be helping us be more successful, not just monetarily, but also spiritually, mentally, and any other way you'd want to be financially, or even any way you'd want to be happy in life. I think keeping our teachers broke is the perfect way to keep our kids that are in school right now dumb and really misunderstanding what it means to be literate or financially literate. If students ask about money and how it works, the teachers really just give them ABC answers and say, look, don't worry about it, you'll learn it later, or let your parents teach you, or you'll learn it when you're a little older, don't worry about it. They don't really want to teach it, right? This means the cycle will continue on and on and on until everybody is trapped by the same cycle. As students, we are educated about the importance of secondary education, and university, college, or some sort of technical school might be what we are asked to go to once we complete our high school or education, depending on the system that you're in, of course. For most people, these types of schools are not affordable, the higher education schools. So the system stresses the importance of getting a student loan. And this loan, the larger it is, the better it is, because the larger your loan, that means you're probably going out to become a doctor, a lawyer, an engineer, an accountant maybe, or something in the sciences that requires you to be in school for longer, to spend more money to get that education so you can potentially one day earn a higher income. The money you borrow for the better education you will get will likely not start to need payments be made on it until maybe you're about 6 months to 2 years out of school. This should give you enough time to start, getting a job, start saving some money, etc. Right? This would be an example of buying a sofa set with the stipulations of not having to pay 5 Christmases from now. You'll see those commercials on TV where they say, buy now, no interest, no money down, pay later, right? That's the same thing that these student loans are doing to people when it comes to the education that these guys are trying to achieve for later. Pay later, pay later. Don't worry about paying now. Don't worry about it now. And that's what we do. We don't worry about it now in the hopes that our money will be there for later so we can pay these loans back. One of the things I did see is most people, when they do pay the loans back, they just pay the minimum payment because that's all they can really afford to do. Most people who take advantage of these student loans will pay down, I guess, over the next 10 to 20 years on average, a student loan. So that means if you completed school at 25, you're most likely still paying this in your 30s and even potentially into your 40s. Sometimes even to your 50s, depends. I've seen people who are forever students and still going to school and still taking loans, and they're always going to be paying their student loan based on the money they keep borrowing in the hopes that they never have to pay it. A few years after graduating, you may start your job and you may want to get married and start your own family. Well, on the average, most people, they have about 2 kids. As soon as they have their children, they're told this is the perfect time to start your child's education. So what do? They are told to invest the money monthly on a monthly basis into their child's education. You and I are sold the idea that education will be very expensive 20 years from now, so you better start saving today. Who can say no to that? Because again, who are you saving for? You're saving for your children. And of course you want the best for your children, as I would. I have a daughter, I want the best for her. So I started saving, not through the banks and not through the system they want. I started saving through my own system based on understanding how that system works. In Canada, in other countries, I'm sure the government will match up to a certain dollar amount the contributions that you make to your children's education. We are told that you'll get free money from the government. Now, who can say no to free money? Geez, it's so hard, isn't it? And then they'll take the free money. Because your children will not go to school for the next 18 to 20 years after birth, there's the next money trap. We are sold the idea that investing money again for school, for the next generation, for the long term, is very good. So what are we told to do? Put that money in a long or medium term investment that will grow for the future. We're told that if we put that money aside, this money will be perfect for the child when they're older. So essentially the system is saying, give us your money for the next 18 to 20 years or longer, and don't worry about it. You don't actually need your own money. We'll take it, we'll grow it for you, and instead of paying your student loan down with that extra $25, $30, $40 a month that you're putting aside for your children, you are now struggling to pay your own student loans down, the principal, you're only paying the interest, and now you're starting to save money for a child that won't be going to school for the next 15, 20 years in the hopes that your child will want to become a doctor, an engineer, a lawyer, or something that's going to cost a lot of money, because that's what they tell you. The better your job, the better your position or title, the more money you will make. So you're kind of sold that. The next money trap I always see people do, and even myself. I have a mortgage myself, and I understand that it is a trap, but I do have one, so full disclosure on that. But that is a money trap that I do see. As we get out of school, the first thing we do is we move out of our parents' place, and we're told to get a place of our own. So the first thing we do is either rent or we get a mortgage. Have you heard of these statements before? It is better to own than rent. Renting is like throwing away your money. Buying a home is an asset that appreciates over time. The value of your home in the future is a great way to save for your retirement. You could use the equity in your home to make other purchases. So this ties into one of the other videos that I've done where we're talking about line of credits. That one will just be called the home equity line of credit, where you can borrow from the equity of your home to make purchases or do renovations or anything like that based on payments you've already made on your home. With these statements floating around, it's no wonder why people buy a home, a condo, a townhouse after they do move out of their parents' place. It is true, you can borrow money against your home. The money can be used to finance other purchases, like we just talked about, other expenses, but you borrow money off your own money. So the bank is lending you money back based on what you've already paid. This means you're paying interest on the money you've borrowed and paid interest on before. Now you're just borrowing it to pay more interest on it later. And sometimes it's even at a higher interest rate than you initially paid it back at. So let's say you buy a home. Now you're stuck at one location for possibly 20, 25 years or longer, because a lot of people do get 30, 35-year mortgages, the typical amortization period of a home, condo, or even a townhouse. Sure, you can sell early, but to do so, you'll be breaking the agreement. You'll be paying penalties for breaking the contract. You can sell your home in the wrong time in the market, lose money. You can potentially sell your home in the right time in the market, but maybe not find the right buyer because you're asking way too much for the home. So you're always going to be playing with that potential problem of trying to sell your home at the right time. Now, typically, your down payment on your mortgage is going to be between 5 and, let's see if I can do this, 20%. but you're tying up all that money in your home too. And any additional equity that you gain through monthly payments can eventually also be tied up in your home until you're able to sell that home. So you can have a $600,000 home or a $200,000 home with 5 to 20% down as your initial payment, and then you can start putting payments down on it. And every payment that goes to the principal is now locked up, which the banks can use and you cannot use to borrow your own money. And if you do want to borrow it, you got to pay interest on it, where the bank, you've already paid interest on that money, is now borrowing that money and lending it out to somebody else and asking them to pay interest on the money you should potentially be getting paid back on, in my opinion. This is a missed opportunity, I believe, for us. The other thing about getting a house, that most people have a conventional mortgage. This generally means that they put down 5 to 19%. They don't put that 20% down, because at 20%, there is no mortgage fees or mortgage insurance needed typically. But if you're anywhere between 5 and 19.99% down on the home as the initial payment, then you will have to purchase insurance on that, which will typically, depending on the value of your home, be anywhere between, $8,000 and $20,000. Can be more especially if you're owning these $1 million homes. It could be a lot higher for that. The truth is, the word mortgage actually means death trap itself. That's the actual definition from the way I heard it. So, I'm going to say it. I never researched it, but you should if you want to check it out. So let's take an average home of $300,000 with an interest rate of 2.5%. That means over the 25-year period, you will have paid on a $300,000 home $125,000 of interest. Now, remember that student loan you got earlier? That student loan could have been paid off, and with that $125,000, especially if you were going to be a doctor or a lawyer or anything in that kind of nature. What if the rates go up in the long term? Not only does it take you, not only would you pay more money towards the interest now, the principal you're paying is less because the interest rates are higher. So the interest rates can go up to 3.5 to 8%. They have gone up in the 70s, in the 80s. They are pretty low right now in 2020, just based on everything that's going on with the coronavirus. The banks are just giving out money like it's candy. It's essentially free money right now. So a lot of people have taken advantage of remortgaging, restructuring their loans and whatnot. But it's a good idea. But again, if the economy starts changing, coronavirus goes away, based on 2020, then these interest rates can go up to 3.5 to 8%. And then where does that put you? That means the $125,000 you paid at 2.5% at, for example, 5 to 8% can be almost double to triple in the interest. So it's very tough. No one really knows the economy and where the rates are going to be. The Bank of Canada in Canada, Federal Reserve in the United States, continues to monitor and determine what the interest rates will be based on where they want the economy to be over a long period of time. The last thing about the mortgages and why it's a money trap is because of the interest rates. You have no control on them. You can't get a lower interest rate than what is being offered to you. You can't negotiate for the most part what that is based on it. Like, you might be able to get a little bit better, but typically it's going to depend on your your credit score, and of course the bank wants to make money, or the institution that's lending you money wants to make money. So they're very reluctant to give you percentages or breaks on your interest, because again, the more they give you a break, the less money they will make. But again, in the big picture, they're still making lots of money, and just like anybody, they want to make more and more. So number 3 money trap. I believe this one is called, it's known as different things in different countries. In Canada, it is known as an RRSP, a Registered Retirement Savings Plan. I believe in the United States, it's known as a 401k. Again, these are just retirement savings plan. No matter what the name is to help you save money for the future when you need it yourself, because you don't need money today. So the third money trap I find people is investing in their retirement, again, to live a comfy and cozy life when they're 65 and not live a comfy and cozy life when they're in their 20s and 30s, because that's when they're told to start saving for that comfy life when they're 65. That's the money trap. Most people, depending on stats, may not even get to 65. And if they do, what kind of conditions are they in? Many people are encouraged to save money at a young age, like I said, and put it away for retirement. You've heard this statement: the government will not take care of you when you're 65. There will be no pension plan or security plan when you are 65, so you better start saving in your 20s. Statements like this get people to think about saving for 65, which is nothing wrong to put money away for 65, but you gotta be able to pay off those interest loans that we're taking when we're in our younger years, and our what we talked about was the education, the mortgages, the different loans, the credit card products, all that kind of stuff. We got to be able to pay all that stuff down before we even start thinking about 65. My personal opinion again. We're told that we need to take care of ourselves because no one will take care of us later. So that's the money trap. The old age, the pension, the retirement savings programs, they set us up to think about that and not really think about how can we be successful starting a business or increasing our incomes if we're working jobs. Instead, they say take what little you have and put it away for later. They're not ever really trying to teach you how to make more, have abundance, so you can have abundance in the future. The idea is to entrust the government and the banks for your retirement and your savings. Give the money to the same people who do not have a long-term investment in you. Because if there's going to be no old age security, that means the government's not giving it to you. But now you're told to give the money to the banks and the government so they can put the money away and make it work for you later. Shouldn't this be a red flag? Red flag. I don't know how else to tell you. In my younger years, in my 20s, I got suckered into the same scam too. I started putting money away into RRSPs and mutual funds and learning about all that kind of stuff. The problem is most people can't really afford to put a lot of money away into these type of things because most people don't have enough money to even live 90 days out. Most people, if you look at their bank accounts, would be broke, living on the streets because they wouldn't be able to pay most of their bills if the companies did come and shut off the lights, take away everything that they've worked so hard for. But let's go back and let's take a look, right? So what they want you to do at the banks is say, hey, look, don't put away hundreds of dollars. We know you don't have it, but why don't you put away something small, like $25 a month? But you can substitute any number because they'll try to get you to put any number away. But if you put away something small, $25 a month, again, you're not putting that, now you're putting $25 a month for your RSPs, you're putting maybe $25 a month for your children, and you're paying, other bills and whatnot. But should you not be able to put that $50 towards your student loan? Well, why would you? Because why would you want to pay the principal down when you could just pay interest for and a little bit of principal over the next 30 years? Think about that. Isn't that kind of backwards? Shouldn't you pay off the loan first and then start putting money away for other things? Because the more loans you have or more money you have going in different places, the less likely you are to make those payments as quickly as possible for your own future. So this means in 1 year, you'll invest $300 to receive a tax break, let's say about 30% worth. That means in 1 year, the government will give you back $90 for putting back towards your retirement. But what do most people do with that money? Most people will take that $90 that they get back from the government and they will put it and spend it, go buy something. And that money that they got back from the government for their retirement didn't go to their retirement. And now they only got $210 because when they pulled the money out for retirement, they will have to pay tax on it again, and maybe not at 30%. Let's say you're paying at 20%. So you pay 20% tax, you'll get back, let's say out of that 300, you got to give back 60. I'm not going to do the math right now, but that means you've paid away $40 of your money. So now you've paid $40, you've lost it. So you're $300 is now effectively $260 because you spent that $90 you should have saved. And now when you're older, you're actually even in a worse position because you didn't save the money for the future, which is what it was actually meant to be based on what they were telling you. But they don't tell you to do that. What do most people do? They put on that. What could you have done with that $90? Maybe paid off your credit card. Instead of paying, for dinner, you could have paid off a 22% credit card and helped you lower the balance based on what you owe, right? So that's another money trap that I feel that a lot of people are getting themselves into. Tell me if you've heard this. When you're younger, you need to take the most risks. When you're older, you take less risks. Well, would that really make any sense when you're older to spend all your time risking all the money that you're working so hard for? Sure, it can help you. Absolutely, you can make some really good business moves if you're taking risky and making risk decisions, but calculated risk decisions to put yourself ahead. But these mutual funds is kind of what we're talking about, and that's where they want you to put their money. So if the market goes up or down, don't worry about it. You got lots of time to make up the difference because you're going to continue to put more money in here for us to manage for you for a nominal fee of typically about 2.5% to 3%. So what happens is you put the money in there, you go ahead and you're losing money on the money because if the market goes down, you still got to pay these management teams that 2.5%, 3% for them to take care of you and your investments that they are managing. Another thing you can do, and I've seen this happen, and I've done it myself, but I've done something a little smarter with that money instead. So another thing you'll see is something called, at least in Canada, I believe it's called the flex option or something along that line. This is where you can take a loan, let's say, for example, $5,000. And again, when you take a $5,000 RSP or 401k loan based on a 30% interest rate, which we'll get back. Let's say you'll get about $1,500 back from the government on that $5,000 RSP that you got this loan, you invested back into the RSP. Now you're making money in the stock market with the RSP or through the mutual funds. You are borrowing $5,000, so you got to pay that back. Well, you're borrowing that money, that $5,000 at a pretty decent interest rate, let's say 4, maybe 5%. So of course you're spending money to make money, but you're paying more money on to the management team. So no one really does the math and really understands that money and where it's going. But we're just told, hey, look, it's an easy way to borrow money. Take a $5,000 loan, you'll get $1,500 from the government, then you can use that money to do what you want. A lot of people just spend that money again on that $1,500 to book a trip to go somewhere. What I typically used to do was take the same $1,500 as in this example and put it back on the loan that I had gotten from the bank. So my $15,000 on a $5,000 loan would bring my total back down to $3,500 if I hadn't made any payments as quickly as possible. Now, instead of taking a whole year to pay it off, I can pay this thing off in maybe 8 months or whatnot, right? Or another good thing to do was to take that $1,500 and you have any high interest credit cards was to pay that off. But we're not taught to do that. Most of us say, hey, I just got $1,500 from the government. I am going to take a crazy vacation. They go to Mexico, Cuba, Dominican, Hawaii, whatever. But they don't really think about what else that money should have been doing or where that money even came from when they made that investment. And nor do they think when they, again, have to pull the investment out when they're 65. They'll have to pay that taxes back on it. So now instead of let's say that $1,500, which they should have kept for themselves in their bank account or paid off some loans, they will have now less money because they'll have to pay the government, let's say 20% back. So they'll have to pay $1,000. And now they're losing $1,000 out of that $5,000 that they had initially set up for their retirement. So now they only got $4,000 for their retirement from their investments, plus whatever they made in the mutual fund, if they made anything, of course, for their retirement. And instead, now they're actually a little bit backwards. So this sounds like, again, a scam to me. The winners in the investment styles is the person you give the money to. Now, since the money is going into the stock market, no one really has control over that, especially the managers, the money managers of these banks. Only these big hedge funds that control trillions and trillions of dollars or multi-billions of dollars are the people who really have control, who use computers to do algorithmic trading. The bankers can't really keep up with that stuff. They don't do algorithmic trading. They just do managing of your portfolio. So that's kind of what they do, kind of the idea behind it for themselves. I want you to really be aware of what is going on these three money traps. So again, schools, get an education, get a loan, mortgage, borrow money, get a loan for your children's education, not just your own, and again, RSPs or investments that you really know nothing about, that you really don't have an understanding, and you're putting such a small amount away in hopes that that small amount will become double, triple? Well, if you put $300 away and it takes 5 years or 10 years to triple $300, well, you got $600 after 10 years. Let's just think about that for a second. Hopefully that made sense. Again, these are at least three money traps that I've come across and encountered, and different ways to avoid them and think about them, at least when you are faced with the thought process behind, should I be borrowing this money? Should I be getting a mortgage? Should I be putting money in investments? Something for you to think about the next time you go out and are approached by your financial institution. Again, my name is Maveen. I am from discoveryourlifetoday.com. If you like this video, please remember to share. I would really appreciate that. Like it, leave a comment below. Let me know if you have a mortgage or have fallen for any of these money traps just like I have as well, right? Let me know what you think. Leave a comment below. Remember to subscribe, and I hope you have yourself a fantastic day.